Today, I have a special guest online, Gregg Gossett. Now, Gregg, this man is a man of many means and much wisdom, and I am so excited to have Gregg back on today. You've probably heard Gregg on the podcast several times before, but it's been a while since he and I just had a chance to chat like this, and so I wanted to kind of bring Gregg on and talk about what's new and what's new out in the trading world, what's new with him. And we were talking earlier before the podcast about maybe some other things that people aren't considering whenever they're looking at their trades. Gregg, really excited to have you back on today.
Hey, Chris, appreciate you having me on. Nice to see you again.
Yeah, it's been too long. I think it's been 3 or 4 months since I've had a chance to chat with you.
Yeah. And
I tell you what, a lot's changed in 3 or 4 months, right?
It has. It's been a wild market.
Oh man, this world we're living in. Now, Gregg, you're in Utah, right?
Yes.
Yeah. How's it going over there with the virus and everything? Are you guys doing okay?
I live up near the mountains. I don't go into town very often. I'm kind of a hermit, So yeah, I don't have any friends that have had it or any bad news in that respect.
Oh, that's good. Well, here in Texas, I'm sure you've seen the news. It's just like off the charts.
Yeah.
And I was driving out with my family one day, and we drove past a baseball stadium, and it was literally full of people. It was like minor league or something, or little league, and the whole stands were full. There were kids playing on the field, and I'm looking at my wife, and I'm like, "What world are we living in right now? Who's allowing this to happen?" And of course, now it's going to continue just exacerbating the situation to make things even worse.
Right.
So I don't know what's going on out there, Gregg, but I know we're going to try and stay safe, and we're going to try and keep our social distance here. We'll do this by Skype today, and we'll be okay.
Sounds good.
So, Gregg, a lot's changed since we talked, and gold is one of those trades that has taken a lot of people by surprise. Yeah. How have you been trading gold? Have you been trading gold at all?
I have been trading gold. I've had a few good gold trades. Actually, one of my students has caught this entire move. I'm so proud of him. He's using a crossover, 520 EMA crossover. And, sometimes those crossovers can have huge gains. And so he's ridden this thing all the way up. So really glad for that.
Great. Yeah. I've been really fortunate on this one. I had been working on some systems on my end, and I had been back testing a bunch of different things. And right about that time, I saw that the gold 20-day exponential moving average tested really well. And it was right around the time they had crossed that. And I was like, I'll go ahead and put it on and just see what happens. And I've caught 12% of the move. So I've been real pleased with that.
Oh, congratulations. Yeah. That's fantastic.
Yep. It's not like gold futures or anything. I'm just trading GLD, but it's done okay.
Right. No, that's fantastic. Could you imagine if you were trading futures?
Woo. Oh, wow. I'd be buying a couple new houses today.
Absolutely.
So, that kind of goes and leads into our discussion about, position sizing and risk and things like that. And while I could have gone and put on gold futures, and you've shared some of your stories before with futures, they can be a lot bigger of leverage and risk than I am willing to take. And that's why I don't trade with them. Yep. Would you mind sharing that story real quick about what was it you sold when you didn't mean to?
Japanese yen. I'll never forget this. I had 2 Japanese yen futures contracts. Went to the gym, came home, looked at the account. They were up nicely, and so I said, I have 2. I'll sell half here, lock that in, and let the other one be a runner. So I went to sell one contract. I hit 1 on my computer. I thought I was selling 1. I hit the sell button. I went outside. I came back in. I looked at my account, and I was down about $66,000 on the trade. I was in shock. I was like, I had a profit on this trade. What's going on? Well, what happened was previously I had bought like 100 shares of Amazon. So it was in the cache in my computer. When I hit 1, it sold, it picked up that 100 amount. So instead of selling 1 contract, I sold 100 futures contracts of the yen. So I went from being long 2 to short 98 full contracts.
And that was definitely not part of your trade plan.
That was not part of the plan. Although, you know, I literally had to force my hand to my mouse to cover the trade once I realized what happened. But I mean, I was in shock. And fortunately, there was a Bank of Japan announcement right around that. And before I could get myself to get to the mouse, they had announced something and it went dropping down. So it went from like a $68,000 loss. I only took a $2,200 loss. However, however, had I stayed outside just like 5 more minutes with my dog and come back, I would have made like $200,000 on that position, because then it went.
That's well beyond the realm of my trade size for sure. I couldn't imagine that. But then again, it's like I think you executed it as best you could, honestly. I mean, just think if you had come in 30 seconds earlier and clicked the button, you'd be down $66,000, right? Instead of $2,200.
Well, it just took me a minute to process it. It took me a minute to process it. It took me a minute to actually move my hand, because I was just like, what? I had a nice little profit here. Well, how is this possible? Like, I just thought it was at a bad tick, or it was, anyway, lesson learned. And I always tell my students and people in the podcast, I'm like, look, take the extra 3 seconds, 5 seconds, just make sure you're buying what you want and really how much you're buying or selling what you want and how many shares or contracts that you want. Just take the extra 5 seconds just to confirm.
Yeah, absolutely. And so we bring that up today because Greg had a great idea talking about position size and stops and working that around volatility. And as I mentioned earlier, I've been working on some new scenarios on my end. And I've been reading the book Trade Your Way to Financial Freedom by Van Thorpe. And in that, Greg and I were talking before about that. He talks about, so many people focus on just the entry, when really the entry may not be all that important. It's what you do after you've got the trade on. How big of a trade are you taking? What's your stop on that trade? How much risk are you actually willing to take? And while talking about that with Greg brought up the 2 ATR. And that's something I've never traded before, but it's something that he relies on with significance. So Greg, if you don't mind, let's talk about the 2 ATRs and why do they matter to you, and how are you using them in your trade plan?
Yeah, so like you said, most people focus on entries and exits, indicators. Most books, that's what you learn about. But what I have found with dealing with a lot of traders on a daily basis, and especially new traders, and even traders have been around for a long time, I find that they give no attention whatsoever to what's going on with the volatility of the market. They may just say, hey, I always buy 100 shares of everything. Well, look, in January of this year, if you bought 100 shares, fine. If you come into March, that 100 shares, the volatility increased 4 times. So even though you're still trading 100 shares, your risk has increased 4 times. So most traders, in my experience, they focus on entries and exits. They don't look and say, what's going on with the volatility in regards to my position size? The greater the volatility, you should reduce your position size to reflect what the volatility is doing. And That's why I use the 2 ATR. ATR stands for average true range. 1 ATR means that the stock price or whatever you're trading, that's the expected range over, like, say, the last 20 days. It's the expected range. A 2 ATR puts you way outside of the normal expected range. So if you're wrong, you know you are really wrong. Most people put their stops so close inside of what just a normal range would be, and they kind of get stopped out for no reason. So the nice thing with the 2 ATR is, one, it adjusts for volatility. If volatility has been larger, the number gets larger. If the number's larger, you divide that into your maximum acceptable loss on any one trade, and you trade smaller. If volatility is smaller, then you can trade larger. So I think the best thing, it gives you exactly how many shares you're going to buy based upon what the recent volatility is. You take your maximum loss, just a good rule of thumb, 1% of, I'm going to lose a maximum of 1% on any one trade. I take that number, say you have a $100,000 account, 1% of 100,000 is 1,000. You divide the value of the 1 ATR into your maximum allowed loss, and it will tell you exactly how many shares to buy based upon the volatility. When I teach my students, I tell them really one of the most important things I can teach you is adjusting for volatility and having a proper position size, because then, regardless if the volatility is low or if it's big, you're only going to always lose that $1,000 based upon what the volatility is doing.
Yeah, that makes sense. So when you're describing that, it's essentially bands that go above and below the current stock price, correct?
Well, it's a range.
Okay.
Let's say Apple over the last 20 days, let's say the average move, you take the high and the low of the bar for the last 20 days, you average them up, you divide it by 20, and it will tell you Apple is expected here. Apple here is expected to move right now an average of 10.9 points per day. That's just the average move per day. So I'm going to take double that, 2180, and that's going to be, if it moves more than what it's expected to, I know something's wrong. Okay. It's just the average range of the move. I mean, of course, Amazon, if we look at Amazon, the average range on Amazon is 126 points per day. So if it moves 40 points, you don't want to put your stop at 40 points because the average move is 126 points. Does that make sense? Yeah. So you want to put it outside of what the normal is.
Okay. So let's say you've got the top and bottom range and you're moving from day to day, and let's say the stock price is going down. I guess it'd be this direction. How would that look like? Would it be going outside of the bands like that, or would it be just would they both be moving down in tandem? And obviously, if they're both moving down in tandem, that's not the trade you'd want to be in.
Well, it's just more of a measurement of how large the bars are. Let's just say the average range, like when I'm looking here on my computer screen, they're bands. They look like Bollinger Bands, but sometimes they're narrow, sometimes they grow, sometimes they come back. As volatility or range is small range bars, they're like this. As volatility increases, you see the bands increase, showing the increased volatility. So when those bands start expanding, you want to take a smaller position size. When they start contracting, then you can take a larger position size.
Okay. So that's where my question is like, if your bands were small,
yeah,
and then they grew, you don't keep the same size of trade on, but you would still keep something on until the price goes below the bottom of the band? Is that what you're thinking?
It's not really, doesn't have anything to do with going above or below the band.
Okay.
It's just a measurement of how far the range was over the last 20 days. So, let's just say stock's moving sideways, the bands around it are going to be very narrow. If it starts to move large, either to the upside or the downside with large bars, it's going to start to increase those bands. So it just shows you what one ATR, it shows you what the average range is over the last 20 days. And if you see a big bar that moves up or down that's larger than the average, then you know something's changing. But the real reason, I mean, I use them for a lot of different reasons, but the main reason I use them for is just to tell me how many shares I'm going to buy.
I see.
Something.
So
as they increase, the number gets larger. And the larger number tells me to buy fewer amount of shares.
That makes sense. Okay, so you're not using them as exit points. You're using them for sizing.
I'm using them for sizing. I do use them in other parts of my trading. The third ATR channel, meaning that it's 3 standard deviations away from the mean. 92% of prices, if you have a third ATR channel, 92% of prices fail there, go back down. If you have a negative third ATR channel, if you go down to that negative third ATR channel, 92% of prices go back up. So I use them for both position sizing, measuring volatility, and also for important levels to trade off of.
Okay, very cool. Yeah, that was a lot to cover there. I appreciate that, especially since we don't have like a screen share where we could go into all of it.
If you were doing screen share, it would be much easier.
Yes, I can believe that.
Yeah.
So Greg, what other keys are you looking at when we're talking about size and volatility? Like for me, I always use a percentage of my portfolio for a certain trade. Like let's say for example, it's always going to be 5% of the portfolio is my position size. Not that I would risk 5%, but that's where my position size is. And then I have trailing stops based on how much I would lose.
Yep.
So obviously, with that being said, it can range wildly from one stock to another based on the price of that stock, right? A $100 stock I could buy 3 times more of than a $300 stock.
Yeah.
What other keys or indicators or rules of thumb are you using whenever you're looking to size your risk?
Mainly the 2 ATR reading. You see, if you use a standard 5% position size or a standard 10% position size, it's not adjusting for the volatility.
Yeah, that makes sense though. I understand where you're coming from.
If you use a 5% volatility and volatility at 5% position size of your total capital and volatility increases 3 times, it's like you're using a 15%. So that's what's so great about the ATR readings. It adjusts for all that. So instead of buying, if you're used to buying 150 shares of something and volatility increases 3 times, it's just going to tell you to buy 50 shares. So you're always standardizing it. So, but as far as position size and volatility, that's the only tool that I need. And most platforms have ATR channels. Another term is Keltner channels.
That's right. I've heard that before. Okay.
Yeah, it's in most platforms. And so I just go in and say, what's the reading of 2 ATRs? I just look here at my screen. It tells me exactly. I take my maximum allowed loss, divide that number into it, and it's like magic. It adjusts for volatility and tells me exactly how many shares to buy.
Very cool. I am going to this afternoon start working that into my plan to make sure that I can adjust for volatility, because that's definitely not something I had considered on my sizing before. But I'm always open for improvements. So I'm happy to help you get set up. You can Skype me one night or whatever. We can share screens, look at your charts, and I'll help you get that indicator set up. Sure. So Greg, what are we going to tell people out there with the market, right? We had this huge blowout earnings yesterday in the NASDAQ, and then today it's 1:30 right now, but earlier today the NASDAQ went from up like 2%, and now it had gone red the last time I looked at it. What's going on out there? Should we be starting to cut our positions shorter? Should we be looking to scale back? Is the ATR growing right before our eyes?
It is on the NASDAQ stocks.
Yeah.
Because of this huge move up, it just increased it increased the value of what's going on with the ATR. So it would make you trade shorter. I mean, it's tough to say. I mean, you have to have a trading plan. You have to position size correctly. You have to adjust for volatility. You have to wait for a trigger to get into trade, whatever that trigger is. You have to have, you have to keep your the support that's underneath you. I like to have the support just as close to my entry point as possible, so that if I'm wrong small, and if it goes my way, you have to have the courage to hold on to it, right? I mean, it's big wins, small wins, break-even trades, and small losses. That's the formula for profitable trading, and getting your ego out of the way. If you take a loss, just get rid of it. I always use the analogy of a garden. Plant your flowers, plant your vegetables. If they turn into vegetables and flowers and they're growing, leave them alone. If you have weeds in your garden, in this case, weeds would be losing trades, get them out of there quickly before it takes over. Your first loss is your easiest loss. It's very hard to get rid of losses that you've held on to because of your ego. It's hard. It's easier to take a little weed out of the garden than a big old weed.
Oh, yeah. There was I don't remember who said it, but it was in the New Trader, Rich Trader group that you and I are in. And you guys are welcome to come and join us on the Facebook group. It's run by our friend Steve Burns, New Traders, Rich Trader. Somebody in there posted one day, and I was like, "Oh, that's kind of brilliant right there." It was cut your losers short and let your winners run wildly out of control. And I was like, "Ooh, I like that. That's a good way to look at it."
It's exactly right. And unfortunately, most of the time, it's exactly the opposite of what people do.
Yeah, I had several trades this particular week. We're in a choppy market, which has been a little bit frustrating. But I had several trades this week where it's like I put them on, let's say Tuesday, and like Wednesday at the open, I'm cutting them off because they're below my stop level. And like I'm so psychologically over it now. It's just like they're throwaway trades. I don't care. Just get off my screen. We'll get on to something else.
Exactly.
Yeah. So that's helped me a lot.
This is exactly how you should look at it. It's easy to take that quick, small first loss. But it's hard. It's hard to take
when it is close to your signal line. There was something you said, and I can't remember exactly what it was, but it was something about whenever you trade with a moving average crossover or not just a crossover, but moving averages in general, right? When it goes above that price, it's designed so that you have small losses and you have big wins. And that being the case, right? So on Tuesday, it was just above that line. On Wednesday, it was just below that line. And my stop level was on the line. So it's like immediately gone. Didn't even have to do anything. And it just executed the trade for me. And, that was something I started incorporating when I started building my new trade plans a few months ago. And that has made things so much easier to just set these automatic orders and they close. And now I don't have to worry about my losers running out of control. I can let my winners run out of control.
It's perfect. It's absolutely perfect. But just get rid of those losers quickly. Let those profits run. Have a plan. Adjust for position size. Don't have too many positions. Don't have too many correlated positions. That's another thing I see people run into a lot there. And I say, how many positions you have? I'm like, there's 6. What are they? Amazon, Google, Apple, Twitter, Intel. I'm like,
yeah,
little correlated, right? Let's get some diversifications, maybe over into healthcare. I'm a big proponent of trading on diversifying my trading approaches, diversifying what time frames I trade on, whether it's the weekly, the daily, intraday, and it's also important to have diversification in the type and industries of stocks that you have, and even outside of equities like bonds or gold or silver or the dollar or something like that as well.
Yeah. Well, Greg, I know that I've got some homework to do. I need to go work on these ATR bands and start incorporating them into my position size. So I appreciate you bringing that to my attention today. Thank you. And I hope the audience got something out of that as well. If you're not doing the kind of things that Greg says, I mean, this guy's been around, I don't know, like 2 or 3 years at this point, and he knows what he's talking about. He's been doing this for quite a while. So anytime you can get some advice like he's talking about, you should probably take him up on it. And then make sure you guys go and check out Greg's YouTube channel, which he's about to kick me off so he can go and do his show. And that's over at Gossett Trading and Mentoring Live. And he's there every single day, which is way more work than I have time to do.
Yeah, we're there Monday through Friday during the last hour of the market. And we talk about ATR channels and all sorts of stuff on there. And so if you come by, you have any questions on them, then I can actually show you on the screen. And I think you'll be able to understand it. And if I can help you with it, Chris, you just let me know, okay?
Yeah, sure thing. Well, Greg, this has been really wonderful. I'm so glad we were able to connect again and, pick your brains on this kind of stuff. I tell you, it's not so much a secret anymore because I've shared it a few times, but the podcast is kind of selfish. It gets me an opportunity to talk to people, smart people like you, and then I can have the audience out there also benefit, right?
Win-win all the way around.
Yeah. Well, Greg, thank you so much for your time today.
Thanks, bud.
Yeah. And thank you guys for tuning into today's How to Trade Stocks and Options podcast. Make sure you like, subscribe, and enable notifications. That way you never miss any tools, tips, and tricks to help you trade faster and trade smarter. And I'll see you on the next episode. Well, thanks a lot, Greg. That was
thanks, bud.
I'll definitely be checking that out. I really do appreciate it.
U.S. government required disclaimer. Stock, options, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.